We evaluate startups in the space, and we define a thesis. Here's the type of things that we invest in. I try to be so communicative on our website, on LinkedIn, about what we like, what our thesis is. And that's one thing I try to give good advice to startups. If you're going to pitch a VC, really, really understand their thesis and also understand the type of companies they've invested in. And if you don't fit, do not waste your time. We're kind of an engineering analytical bunch, right? It has to fit. It's not good, bad, it's fit. And I do all that, and I still get movie scripts sent to me. So it's like, where does it say I invest in movies?
That's amazing.
So part of it is you define a thesis and you go to your investor base and you say, look, this is what I want to invest in. So what I've said is I want to invest in disruptive technologies, in the construction and real estate space that are going to transform the industry. And we're going to invest in pre-seed and seed stage. And these are the types of sizes. We tend to write $1 to $2 million checks. We tend to invest in companies that have a pre-money valuation of $4 million to $20 million. And I try to advertise that as much as possible. Coming from the entrepreneurial side, I take I'm super respectful of entrepreneurs. I've been there. And I think there's also a book that you guys met. I wrote a book called What You Know About Startups is Wrong. And it's really about my journey, like almost dying, like just all kinds of stuff, just that founder journey. So I'm super respectful of their time, maybe so much more than even they're respectful of their own time. And so I just try to be so transparent. I book 30-minute meetings. In the first 7 minutes, if I don't see it there, I'm like, hey, I'm going to give you back 23 minutes of your day. Some of them appreciate it. Some of them get pissed off. They're like, what do you mean? I had 30 minutes. Like, okay, sure thing. But that's the job, right? So we raise money from other people. We meet with startups. I meet with about 10 to 12 a week. We get about 50 inbound a week. We due diligence them. And happy to talk about what that entails. And then we take that money and deploy it. And we get paid for managing the money, a management fee. And we get this thing called carried interest, which is basically if we invest $1 million and the company turns into $101 million, we get 20% of the net $100 million, right? So that's how we really get paid. Management fees are really just to kind of keep the lights on and that kind of thing. You don't really make a lot of money. So we make money on successful startups exiting. Now they have to exit, right? So we're not looking for dividend bearing type companies, like cash flow. It's funny, like when people say VCs, like, you guys don't like cash flow. It's like, no, we don't. Cash flow means you're not investing. The better use of that money is to take it out and put it somewhere else than actually invest it in the business. So if you're telling me you're sending me cash, you're saying I'm better off putting money into a 4% CD or the stock market than your own company. That's what that signals to me. Versus if I put it in your company, you can deliver 5, 10x my returns. So it's definitely like a different sport, right? I tell people, you guys ski, there's cross-country skiing. There's lots of skiing. Everybody thinks they're skiing. That's what financial services is. I'm like downhill skiing. That's what I'm doing. So either I'm going to stick the landing, or I'm like that guy from Dating Myself, Wide World of Sports, that goes off the end into the woods, right? That's kind of my life. It's one of those two things.